With the stock market extremely concerned about the coronavirus, let's see what we can learn from a stock market signal that has only been flashed 12 times in the past 30 years. This is being recorded after the close on Friday, January 31st. We had an ugly session and an ugly week, but as we mentioned a week ago, that's not particularly shocking given the S&P 500 was up 13 out of 15 weeks in this window here, gained 377 points. On a percentage basis, that comes to 12.79%. Let's revisit our roadmaps that we started using on January 11th, 2019. Roadmaps that proved to be extremely helpful in calendar year 2019. These are all S&P 500 charts near significant lows. These are daily moving averages ranging between the 50-day moving average in blue and the 200-day moving average in orange. And notice in every case, the transition from full bore bearish to full bore bullish basically looks the same. Full bore bearish, blue, the fastest moving averages on the bottom and all the slopes of the moving averages are down. Full bore bullish, blue, the fastest moving average is on top and the slopes of all of the moving averages are positive. And these were our bearish cases that we looked at where the market tried to rally but failed to recapture the moving averages and failed to reestablish a full bore bullish look. Thus, it might be helpful to know as of the close on Friday, January 31st, 2020, do we still have a full bore bullish look or are we morphing into something more concerning? This chart pretty much speaks for itself. Blue, the fastest moving average is on top. The slopes of all of the moving averages are up and price is above all of the moving averages. And you may remember back on January 11th, 2019, over a year ago, we said what we were looking for was for the market to clear and hold above the moving averages. It's what happened in October. We cleared and we've been holding above. This is a strong trend look here. And so far, it's hard to argue that we're really seeing anything that's particularly shocking after this type of move. Might also be helpful to know, what does a trend strength model look like as of the close on Friday, January 31st, 2020? Do we have a vulnerable score that tells us we should be open to something like this? Based on the facts that we have in hand today, the answer is not yet. Trend strength model actually has two scores, a shorter term and a longer term score. Both are sitting at 100 as of Friday's close. None of this predicts the future. These are statements based on the facts that we have in hand. If the facts change, then our assessment of the probabilities must change as well. Since we've reviewed this quote several times in the past, let's zero in on the portion that's most pertinent to this week's video. All interpretations made by a scientist are hypotheses, and all hypotheses are tentative. They must forever be tested, and they must be revised if found to be unsatisfactory. Therefore, let the testing begin. It's a daily chart of the NASDAQ relative to a diversified basket of bonds. We're using a mutual fund in this case. Why a mutual fund? Because the data goes back further than an ETF. And we know from past videos, the stock market really doesn't care about anyone's personal opinion or the opinion of any entity related to the markets. And the segment that follows can help us with the only opinion that matters: the net aggregate opinion of all market participants related to all subjects on all time frames. This ratio here, if you're familiar with ETFs, it's very, very similar. So looking at the ratio of QQQ to AGG. There's nothing magical about anything we'll be doing here. We're doing it to illustrate basic concepts about trends and risk appetite. In blue, the simple 75-day moving average. In red, the simple 200-day moving average for the ratios shown on your screen. If you know your market history, this rally in the stock market started really at the major low in 2011, and now we're into 2015. And since we know all good things must come to an end, eventually the market consolidated its gains, and you can see this is more of a risk-off look here relative to this risk on or favorable look here. This is the type of look that we want to embrace. This is the type of look in here that we want to avoid. Since we're not predicting, we would prefer this look here to start to morph into something like this. And that's exactly what happened during calendar year 2016. This piece here is starting to look more like this favorable period here. And if we walk forward, we've now morphed into an even more constructive look. And after we could see all of this, measure it, and put it in a model, really good things happened for a long period of time in the ratio of the NASDAQ relative to a diversified basket of bonds. And we know eventually the market needs to consolidate its gains, and that's exactly what happened. Pretty easy to see that this period here looks similar to this period here, and this period here looks similar to this period here. If we walk forward from this look, the chart takes us all the way to January 30th, 2020. In terms of data-based evidence or visual evidence telling us that the market's risk appetite is starting to improve, two things are basically happening here. One, we get a bullish moving average crossover where blue, the fastest moving average, moves back on top above red, the slower moving average. The look on August 23rd, 2016, very, very similar to the look on December 4th, 2019. The second step in our two-part signal is based on this high here and this high here. After the period of consolidation on December 21st, 2016, the 75-day moving average exceeded this high here, aka some form of a bullish breakout. The exact same thing just happened a few days ago on January 27th, 2020. Since this is a two-part signal, let's move back to part one and ask, how many times has something similar happened in the last 30 years? Why 30 years? Because we only have data going back that far. Part two in our Q&A, how did stocks perform walking forward? So this just happened recently in December of 2019. Very, very similar to this look here. Historically, what happened walking forward from this point? Something similar has only happened 12 previous times in the last 30 years. Here are the dates here. And if this signal here aligns with everything that we've been talking about since January of last year, then we would expect to see a table dominated by green cells walking forward. And from a historical perspective, that's exactly what we have. This table shows us what it was like in each historical case walking forward from this point, which is very, very similar to what happened on December 4th, 2019. And this is the performance for the S&P 500 walking forward. In all 12 cases, the S&P 500 was higher 1 year later. 2 years later, 91% of the cases were higher, and the average gain was just over 20%. Therefore, it's pretty easy to say this table here and this signal here that just happened a few weeks ago unequivocally aligns with everything that we've been talking about since January of 2019. Also relevant, when we get the signal on December 4th, 2019, our expectation would be that this look here would morph into something like this. And that's exactly what's happened. And this move from December 4th to the new high that was made on January 27th aligns perfectly with this quote that we've been covering in recent weeks and months. Our hypotheses ought to foretell phenomena which have not yet been observed. This, from a probability perspective, foretold this, just as it did here. We said it's a two-part signal. We just covered part one. Now let's shift gears to part two. And that signal appeared just a few short days ago. Thus, it might be helpful to know how many times has something similar to this look here happened in the last 30 years, and how did the S&P 500 perform walking forward? And the look of this table is hot off the presses. It's based on something that we could see, measure, and put in a model just 4 short days ago. And as we would expect, our table is dominated by green cells, and we have enough red and yellow to help us maintain that all-important concept of realistic expectations about 100% normal and to be expected volatility walking forward. In terms of the percentage of positive cases walking forward between 3 months and 2 years, very favorable numbers on the bottom of the table. Now let's extend this chart backwards into calendar year 2011 on the left side of your screen to see what we can learn by asking this question. Does today, January of 2020, look anything like recent tops in the stock market? If you know your stock market history, fairly significant peaks came in calendar year 2015 and the second half of calendar year 2018. Before the stock market peaks here, when we look in the rearview mirror, look how long we've been in a bullish trend and how extended this trend is here at this point. Very, very similar situation here. The trend begins here. It's been in play for a long, long time. This is an extended and tired trend. This is an extended and tired trend. How does this look and this look compare to the present day? The answer is the present day really doesn't look anything like this, and not even remotely close to this look here. Between this point here and this point here, we have 11 periods. We don't even have one period. In the present day case, or said another way, bullish moving average crossover in place for 33 months before the stock market peaked. It's only been in place for 1.9 months in the present day. So you can make a rational, back-of-the-envelope argument that on January 30th, 2020, this look here in 2015 was 17 times more extended and 17 times riskier than this look here relative to making a major peak similar to this peak here or this peak here. All of this simply speaks to probabilities, and it's based on facts that we have in hand today. We've just shown the present day doesn't really look anything like this point here or this point here. And visually, it's pretty fair to say this point here looks very similar to this point here and this point here. And we know this look on January 27th is part 2 of our study where we're making the new high, which is similar to December 21st and March 7th, 2013. We know from our table that really good things happen walking forward from this point and this point. If something similar, and we emphasize the term if, happened walking forward from this point here, you can make an argument that the S&P 500 1 year from January 27, 2020 could be trading as high as 38.93 based on the S&P level on January 27th. And if you like to study chart patterns, something may have jumped off the page here. You've got somewhat of a downward sloping look here, more of a sideways look in here. In fact, this is pretty much sideways all the way across. Really not the case here. Blue, much, much closer to red in here. This is a tighter, ready to spring to action look relative to the white space that we have in here. And here, the momentum and trend starts to turn up very, very close to the breakout. Really not the case here. Good things happen from this point walking forward. You can make an argument this is a more favorable look relative to this look here. If our goal is to try to navigate between a point A and a point B that could be several years down the road, we know it's extremely important to set and maintain realistic expectations walking forward. Thus, it might be helpful to know what type of volatility did an investor have to endure to walk forward from these dates here to capture these returns here. And we can answer that question by looking at the maximum drawdown walking forward from these dates, which would be very, very similar to walking forward from January 27, 2020, hypothetically. And since we're in the early stages of a trend, it wouldn't be shocking walking forward from these dates which are the early stages of a trend similar to January 27, 2020, if our drawdowns were fairly muted. Historically, that's exactly what happened. From the dates that were similar to January 27, 2020, 1 month out, median drawdown, a little bit over 1%. 2 months out, average drawdown, around 2%. Same thing looking 3 months out. Looking out 3 months from these dates, walking forward 3 months, worst case scenario, historically, was a drop of 4.41%. How does this help us? Basically says if the stock market drops between 2 and 4%, or let's say 2 and 6%, history says that's 100% normal and to be expected. It's also helpful if the stock market drops more than that, because it tells us that we're starting to drift from expectations relative to the historical script. In both cases, muted drawdowns and larger than expected drawdowns, we're going to get good information. It might be helpful to ask and answer, where do we stand as of the close on Friday, January 31st, 2020, in terms of our peak to trough drawdown? Are we in the normal and to be expected category? Or are we starting to exceed expectations? Notice some of the figures in the table here: 4.14%, 4.4%, 4.33%. Thus far, we're not really looking at anything particularly shocking or surprising. We're at 3.13%. There's a big difference between looking at these numbers in a table and experiencing what happened in the last 2 weeks. The big difference is we're watching red screens, keeping this 3.13% figure in mind. This is a slide that we covered in the Friday, December 13th video. Why did we cover this slide? Because we were trying to get mentally prepared for normal and to be expected pullbacks. Because if we want to try to navigate between a point A and a point B, it's extremely important that we maintain realistic expectations. So when we looked at this chart a few weeks ago and covered the fact that between point A and point B, where the market gained 19%, there was a 4% drawdown, a 4.3% drawdown, and another roughly 4% drawdown. And when we showed this chart a few weeks ago, you would say, that makes perfect sense. And when we covered this 1995, 1996 slide in a recent video, between point A and point B, we gained 32%. If I told you that we dropped 1%, 2%, 2%, roughly 4% and 4%, you'd say no problem, that's the way markets work. And when we covered this slide in December, we also showed that something as simple as a moving average gives us a reference point when markets inevitably pull back. And now it's time to use those concepts in the real world. These are reference points during a market pullback. We have absolutely positively no idea what tomorrow will look like, but we're very confident about what today looks like. And we're very confident about what the hard data looks like. Continue to walk forward day by day with an open mind about what happens next. If you're relatively new to these videos, your eyes may zero in on 1998 and say, see, things are about to get really bad. Therefore, it's logical to ask, is 2020 similar to 1998? In some ways, yes. In other ways, as we've covered several times in the past, they are significantly different. Relative to the 2013 case and the 2016 case, this is a much lower probability outcome, but still relevant because we did see a similar signal and hence why it's included. What about the 2007 case? Similar signal at the end of January 2007. The S&P 500 peaks in October of 2007, and then really bad things happen. How concerned should we be? As we covered in a video on January 10th, 2020, not all that concerned at this point. This is momentum on the Dow in the present day. We get a bullish MACD cross here. Really doesn't look anything like these major peaks here. Present day really doesn't look anything like these major peaks, nor these major peaks, and one of them is 2007. This look here is almost the polar opposite to this look here. Like everything else we've covered, this doesn't predict anything. It simply speaks to probabilities. We really don't have to know anything about technical analysis to see that this pattern here looks different from this pattern here. That doesn't negate the 2007 case. It just speaks to probabilities walking forward. And that's why the 2007 case is shown in this table. Given the present day looks very, very similar to this point here, and after that, really good things happen for a long period of time, it's also fair to say that part 2 of our two-part signal firmly aligns with our cyclical major low within the context of a longer-term secular trend thesis. And while the present day really doesn't look anything like the major peak in 2007, it does look a lot like major bottoms in 1954, 1958, 1985, and 1989, simply helping us better understand the probability of good things happening relative to the probability of bad things happening. And since the whole purpose of doing this is to help us manage our accounts in a more effective manner, it might be helpful to know what this table looks like with 1998 removed and 2007 removed. 3 months later, 100% of the cases higher. 6 months later, 100% of the cases higher. 9 months later, 90% of the cases higher. 1 year later, 90% of the cases higher. 2 years later, 100% of the cases that we just covered higher, with an average gain of 23%. Simply helping us keep an open mind about much better than expected outcomes walking forward, while respecting that a 1 to 4 to 6% drawdown would most likely fall into the 100% normal and to be expected category. Given the concern about the coronavirus, logical question to ask might be, how did the stock market perform in the past when we had viral outbreaks? To get the details, you can Google this title here, because we can find the answer to that question on MarketWatch. This article has this table here, 40 years of viral outbreaks. How did the stock market do walking forward? If you haven't performed this study in the past, the answer is probably much better than expected. 6 months later, average S&P 500 gain, 9%. 1 year later, 14%. Median gains 6 months later in all of these cases spanning 40 years, 10%. 1 year later, median gain 17.45%. Simply telling us, based on history, the coronavirus is not a showstopper in isolation. And that statement is based on what we know today. Like everything else, we'll walk forward relative to this topic with a flexible, unbiased, and open mind. Here's another Google exercise if you want to learn more. Google 5 reasons coronavirus fears are overblown. You can pause your video player if you want to read these quotes directly from this article. Something that just happened on January 27th, 2020 tells us to keep an open mind about much better than expected outcomes in the stock market walking forward. And once again, you can pause your video player or Google this title here. But if you listen to Jerome Powell's news conference this week, you know that the Fed is firmly in the market's corner, and that's not really anything new. We've known that since Q1 of 2019, when the Fed clearly telegraphed a favorable shift on January 4th, 2019, a concept that was noted on Twitter on January 4th, 2019. This development this week is significant, and it aligns with this table here, this look here, and all of this here. Walking forward, we'll continue to test the cyclical low within the context of a secular trend thesis, and if needed, we will adjust our hypothesis and thesis. And we know if we want to try to navigate between a point A and a point B that could be several years down the road, it's extremely important to maintain realistic expectations about normal and to be expected volatility. It's extremely important to understand that none of this is a prediction or a forecast. We're simply making probabilistic statements based on the facts that we have in hand today. And all of this helps us answer the question, are we allocated properly? And if the facts change, we must be 100% willing and able to adjust the probabilities and adjust our allocations if needed. And the only way that we can do that is if we head into next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shervacco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.